Wall Street shedding its gains Thursday afternoon, now in the red after U.S. President Donald Trump poured gas on the U.S.-China trade war, saying that he'll slap an additional 10% tariffs on the remaining $300 billion of Chinese imports. With us now to talk about the latest in trade as well as the outlook for the markets, we're joined by Steve Dudash. He's president of IHT Wealth Management. Normally speak to him from Chicago, but he's here in our studio today. Welcome,
Thanks
Steve.
for having me.
Good to see you. So Wall Street stocks now in a defensive tone. Got Staples up, still up, healthcare, and the rest down in the red. After there was a Fed rate cut yesterday, but now it's all about President Trump and the additional tariffs. What do you make of this move?
So the rate cut's old news. It's been 24 hours. That's old. It's big news that he's coming out with this another tariff on top of the tariff that was just 2 months ago, and it basically guarantees we have another rate cut coming, which is insane to think of. Just a year ago, we were talking about getting up to 3% and things along those lines, and now we've got guaranteed another cut here. And so this reinforces what a lot of people, including ourselves, have been talking about. If we're in a no recession environment and the Fed's basically putting insurance cuts out there for us, it's a risk on environment. Buy into this. You see the market run off, jump on that. I mean, this is starting to smell a lot like what happened in the 90s when the Fed started making rate cuts, when the markets were doing pretty well and the economy wasn't that bad, and they were making rate cuts to protect against Mexico and Russia and things along those lines. Now they're protecting against China. So let's go. Risk on.
So you don't see then the recession of 2020 that some people are talking about with this? Trade war escalating?
I think right now the U.S. economy is one of the strongest economies in the world, arguably the strongest. The only reason we're doing rate cuts besides the China thing today was because of what Europe has been doing and basically saying we're at zero and some at negative. We're going to go more negative, and we have to follow them at some point. There's too much of a spread in there. So we've done our rate cuts. We've done our insurance cuts, however you want to look at it. We've got another one coming. That's only going to add fuel to the fire in this economy. Our economy is doing well. Most companies are making better profits than ever before. Take advantage of cheaper rates and ride it out for a little while. Will it be the 2000, 2001 scenario at some point? Probably, but not now.
Now that we just had the Fed rate cut, we're in the thick of earnings season.
Yes.
People said that we're going to be looking at trade again, but now with this, does this push this potential U.S.-China trade deal way back, or does it bring China to the table?
I don't think anyone was expecting them to come back this week with a trade deal. Nobody. This is a long-term negotiation between two monster economies in the world. They can't get that done overnight. And there's a lot of politics involved in this, and there's a lot of fronting. That tweet today might be a little bit of just that. If you read the tweet, it was the most polite $300 billion tariff ever. You know what I mean? How many times did he said, my friends in China, my friends in China? But this is just negotiation tactics. Everyone is pretty much projecting first quarter of next year is when you're going to see the trade deal actually get done. They both have a lot of reasons to get the deal done. When that takes place, there's a big pop. There's a big election next year. Wouldn't be too surprising that they want to pop at the same time. So ride it out.
So perhaps Q1 then you see a trade deal. But in the meantime, you're saying buy in now.
I was saying buy in before the interest rate cut. Then they did the interest rate cut. Now we're getting another interest rate cut. Yes, buy into it.
What would you pick up?
Small cap stocks. They have underperformed large dramatically. This is more broad-based, but they've underperformed large in the last couple of years dramatically. Take advantage of that. Interest rate cuts actually help smaller companies more because they usually have floating rate loans, things along those lines. You're going to get a bigger uptick. The other end of it, you buy companies with big dividend yields now. And I've been talking about this for a while too. There's a lot of retirees out there that are desperate for yield. A year ago, they finally thought yields were going to start going up. They're gone. It's hard to get an income. It's hard to get passive income off of investments if the 10 years at below 2. So find companies with big yields. Energy sector right now has underperformed the big tech run that we've had in the last year. You can jump in on the energy sector. You can get in on cheaper prices, and a lot of them have very nice yields, 5-6% yields that you can take advantage of in the meantime.
Compared to the U.S. 10-year Treasury, which today now is trading at 1.88%. It got the S&P 500 down 0.6%.
And it's going to go lower, right? I mean, don't
How
you
much
think?
lower?
It almost has to go lower. It seems like the bond market is driving the Fed's decisions on this. I know they wanted to hear more strong language just yesterday about it. They didn't get it, and they said, we're gonna drive it down anyway on our own. So
All right, Steve. Well, thanks a lot for joining us with your thoughts on China as well as your outlook, bullish outlook for the markets. Our thanks to Steve Dudash of IHT Wealth Management. I'm Fred Katayama. This is Reuters. Thanks for watching.